Hello everyone and welcome back. I hope you are enjoying this IFRS 18 journey as much as I am. Today's session is a really practical and powerful one. So pay attention my friends. In this lecture, we are going to talk about something that happens in every single financial statement but is often overlooked. That is aggregation and disaggregation. Don't worry, we will break down into simple, everyday language, and yes, we will also go through a clear step by step illustration to help you understand the process of aggregation and disaggregation. Alright, let's begin with the basics. Aggregation and disaggregations are methods of presenting financial information in a way that is useful to the readers of the financial statements, such as investors, creditors, and others. Aggregation simply means grouping similar items together. It is when you combine similar items into a single line item in the financial statements. And disaggregation, on the other hand, is breaking things apart into their meaningful components. It is when you break down an item into more detailed components to provide further clarity. So in accounting terms, aggregation means to combine similar items into one line item, and disaggregation means to break down a line item into more detailed parts when users need more clarity. Now listen carefully. IFRS 18 has given us much clearer and structured guidance than the old IS1 ever did. So this is a big leap forward. And yes, this topic is extremely relevant for practical work. Whether you are preparing financial statements, auditing, or analyzing them, you need to know how aggregation and disaggregation work. Let me divide the process into few steps. The first step is to identify the item that arise from your transactions or events. These items can be individual assets, liabilities, equity components, income, expenses, and cash flows. Now don't confuse these items with line items in the financial statements. These are the just raw pieces of information coming from your accounting records. For example, receivable from customers, payable to suppliers, salary expense, revenue from online sales. These are all items, not line items yet. So before you jump into your primary financial statements like balance sheet or profit and loss, step 1 is to list all the individual items that resulted from transactions or events. Now once we have identified the items, that is assets, liability, equity, income and expenses or cash flows, the second step is to classify and aggregate them based on shared characteristics. You have to simply ask yourself, can I group any of these items together based on what they have in common? Well, you can group items together if they share something in common, if they have shared characteristics. For example, items can be grouped based on nature, like receivable, payable, expenses, functions, such as operating or non-operating activities, measurement basis, like historical cost versus fair value, size or materiality, for example grouping immaterial items, geographical location, like US sales or Europe sales. Let's take a practical example. Suppose your company have receivables from US customers and UK customers. They are both trade related and short term. These receivables are from sales, so they share the characteristics of being trade receivable, and you can aggregate them under the line item trade receivables. Make sense? You group what looks similar and behaves similarly. Alright, moving on to the step 3. Now that we have aggregated some items, there may be a situation where we need to disaggregate them because they don't share the same characteristics. For instance, we might want to separate items that are fundamentally different in nature. Like sometimes, if items are all assets, They should not be grouped together because they are too different. For example, advance paid to suppliers, receivables from employees, and refundable deposits. All of these are assets and sort of receivables, but their nature and purpose are too different to be clubbed together. They don't share enough characteristics to be grouped together. You would not want to mix these with your trade receivables because they serve different purposes. Think of it like this: you won't mix apples with oranges, right? The same goes for financial items. You have to separate what's clearly different. So disaggregate when things are different enough to matter to the users. Alright, now let's get to the action. Once you have aggregated and disaggregated the items properly, it's time to design your line items for the primary financial statements like statement of financial position, statement of profit and loss, cash flows statement, etc. My friends, must remember that the primary financial statements offer a well-structured and informative summary. As a rule, items that share at least one common characteristics may be aggregated into the line items. Therefore, line items may include both material and immaterial items where it is appropriate and beneficial to do so. But how would you decide if an item should be presented as a single line item or it should be aggregated into a larger one? Simple rule: if it is material to the company, it should be presented separately. But if it is immaterial, it can be aggregated with other similar items. Let me ask you a simple question. Would you show consultancy fee to external auditors of £1,200 as a separate line item? No, because it's not material. It would be just part of professional services. But if you have a legal claim settlement of £2 million, now that's material and it's unusual too. It's definitely deserve a separate line item. Okay, now let's come to the final step. Sometimes you cannot mess your primary financial statements with too much details, right? But you still need to give the users more information. And that's where notes to the financial statements come in. IFRS 18 says if you aggregate items into one line items in the primary financial statements, but the detail inside is material, then you must disclose that breakdown in the notes. But don't give notes for every tiny items. Do not overshadow the notes with too much of the insignificant information. The focus should be on the materiality, what matters to the users. This helps users of the financial statement understand what's inside those line items. So if your line item other operating expenses includes £1,800 for office supplies, £2,200 for printing, and £750,000 for litigation settlement, you better disclose that £750,000 litigation item separately in the notes, even if it is clubbed under other operating expenses on the face of profit and loss. Alright, my friends, let's now bring the theory into practice. Because concepts without application is just reading a textbook. So we are not here for that. So now I'm going to walk you through a practical example that will show you how aggregation and disaggregation work step by step. Imagine you are working for a mid-sized manufacturing company. You are reviewing some current assets, and here is the list of your finance team gives you. Invoice due from US customers $12,000. Security deposit paid to a warehouse provider $3,000. Invoice due from Canadian customer $18,000. Advance paid to raw material supplier $5,000. Loan given to an employee $2,000. Invoice due from a UK based customer $25,000. Alright, so now you have got 6 individual items. These are your items, not line items yet, just raw details. Now let's find shared characteristics among these items so we can aggregate them meaningfully. So first, let's spot what goes together. The three customer invoices from US based customer, Canadian customer, and UK based customers are receivables from customers. They all arise from sales. They are trade receivables. So, yes, they share the same nature and function. So, we can aggregate these items as trade receivable of $55,000. Now, what about security deposit to warehouse? It's a receivable but not from a sale. Advance to supplier, it's a prepayment, not a receivable from the customer. And loan to employee, again, it's a receivable but not trade related. So these three don't share nature with trade receivable. But can we group any of them? Well, all these three are miscellaneous current receivable. So we can tentatively group them under something like other receivable of $10,000. That is $3,000 plus $5,000 plus $2,000. Now hold on. Before you jump into preparing your financial statement, take a step back. Ask, do these three other receivable items truly share enough in common to be aggregated? Let's think. Security deposit is a refundable asset. Advance to supplier is a prepayment. And employee loan is internal short-term lending. Even though they are all under current receivable, they serve different purposes. So what do we do? My friends, disaggregate them in the notes, or if they are material, in the primary financial statements. You might decide to show prepayments and security deposits separately, and if employee loans are frequent, show them separately too. Now, based on our analysis, the next step to create line item by aggregation or disaggregation to present these items in the statement of financial position, that is our balance sheet. Let's look at these two options. First option can be to present trade receivable of $55,000 and other receivable of $10,000 comprising of prepayments, security deposits and employee loan. Even separate line item for prepayments and security deposits and employee loan can also be presented if your company likes transparency and these are material enough. So yes, that's the one way. But the question is this presentation in the statement of financial position useful? There might be possible that the individual amount of prepayment, security deposit and employee loan may not be significant enough to mention it as a separate line item. So maybe the more appropriate way would be to aggregate it with trade receivable to the line item as trade and other receivable of $65,000. This is more compact and you then decide the breakdown in the notes. But of course, that depends on the entity itself and its materiality level. There is no universal rule. IFRS 18 says you must not obscure your material information. So if that 5,000 prepayment is, let's say, 20% or 30% of your current assets, show it separately. But if the $2,000 employee loan is insignificant, keep it in the notes. Now let's say you went with the trade and other receivable line item. Then in your notes, you should clearly disclose the breakdown. It would be appropriate to present its disaggregation in the notes. Here is the example of breakdown. Trade receivable from UK customer of $25,000. Trade receivable from Canadian customer of $18,000. Trade receivable from US customer of $12,000. Prepayments to supplier of $5,000. Security deposit of $3,000 and employee loan of $2,000. Remember my friends, user need to understand what's inside these totals. But again, if items are truly immaterial or not useful to disclose in details, don't provide even breakdown in the notes because that would be the overload of small details. So again, you need to apply your judgment. Remember, IFRS 18 does not give you a fixed rule book. It gives you principle and then trust your judgment as a professional. Aggregation and disaggregation are not about blindly grouping or splitting numbers. They are about providing clarity and relevance. Combine what belongs together, Split what needs attention. Use your judgment and don't bury material information under wage headings. And remember, you are not just preparing financial statements, you are telling a financial story. Alright, my friends, we are almost done with this lecture. But before we wrap it up, let's talk about something super important, and that is labeling and describing your items in the financial statements. IFRS 18 says that when you present line items, subtotals, or totals in your financial statements or in the notes, you must label and describe them in a way that faithfully represents their characteristics. It means the name of the line item should clearly reflect what's inside it, so that when a user looks at your financials, they understand exactly what they are seeing. Let me give an example. Have you seen financial statements that uses the label others a lot? Like other income, other assets, other liabilities, everything is just other. Now tell me, what does other even mean? It's very vague, right? So IFRS 18 tells us don't just use generic labels like others unless you really have to. If you have to aggregate smaller items into one group, then use a more informative label. Like instead of other expenses, write other operating expenses. That gives a bit more context. And most importantly, if you are grouping smaller items into one line items, then please give the breakdown in the notes. Explain what's in here. If the amount are not material, then fine. You can just say they are individually immaterial and grouped together. But if any material item is included in a general label, you better explain it in the notes to the financial statements. Are we clear on that? Excellent. Okay, now, one last concept before we close, and that's offsetting. Let me make this super simple. Offsetting means you take one number and subtract another amount before showing it in the financial statements, like showing a net amount instead of showing both the income and expenses separately. Now listen carefully. IFRS 18 prohibits offsetting unless another IFRS standard specifically requires or allows it. For example, IS 12 required you to offset tax asset and tax liabilities under certain condition. That's fine. But otherwise, offsetting is not allowed. Why? Because it hides information. It reduces transparency. It reduces the ability of the user to understand the transaction and events which have occurred and limits their ability to assess future cash flows. Imagine a company had $10 million in revenue and $9.8 million in expenses, and they just show net income of $200,000. You would never know how much business they actually did, right? That's why IFRS 18 says show income and expenses separately, show assets and liabilities separately. Unless another IFRS tells you to offset it, don't do it. Now here is a common question. Sir, what about showing trade receivable net of expected credit loss? Or what about showing inventory net of obsolescence allowance? Is that offsetting? No, my friends, that's not offsetting. That's measurement. When you estimate the recoverable amount by subtracting expected loss, you are just valuing the assets. That's perfectly allowed. Offsetting is when you are netting two separate line items like asset versus liability or income versus expenses. And this is not allowed under IFRS 18 unless permitted or allowed by another IFRS standard. Got it? Brilliant. Alright, my friends, let's do a quick recap what we have learned today. We understood the principle of aggregation and disaggregation, that is grouping similar items and separating dissimilar one. We walked through a step-by-step process from analyzing the individual items to classifying, aggregating, disaggregating, and finally presenting them as line item in primary financial statements or disclosing them in the notes. We saw the importance of labeling and describing items properly and the need to faithfully describe the item so that user know exactly what they are reading. And finally, we covered offsetting and the strict rule that it is not allowed unless another IFRS standard specifically says so. So my friends, do we understand now how aggregation and disaggregation works under IFRS 18? Wonderful. This is a very practical topic and the principle you learned today are going to be extremely helpful in real world financial reporting. Thank you for staying with me till the end and I will see you in the next lecture. Until then, stay curious and keep learning.